This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, August 7, 2026, and this is the After Hours session. Now, let's get into it. The S&P 500 is frozen at 768.56, trapped in a narrow corridor while the Nasdaq bleeds out. We are witnessing a classic fragmentation event. Energy is rallying hard on geopolitical tailwinds, while technology and small caps quietly unwind. Let's look at the tape. Before we dig into the divergence, let's check the calendar. There are no major macroeconomic releases scheduled for this afternoon. However, the market is bracing for the upcoming non-farm payrolls report. The last print showed a softening labor market with a minus 23,000 month-over-month change and unemployment ticking up to 4.1%. That data is the spark waiting to hit the powder keg of the current mixed regime.
Watch the reaction in the Russell 2000. If the prior non-farm payrolls print was the warning shot, this week's pre-non-farm payrolls positioning in IWM tells us whether capital is hedging for a slowdown or doubling down on the rate cut narrative.
Here is the snapshot as of 16:35 Eastern Time. The S&P 500, tracked by SPY, is holding at 768.56, down just 0.16%, clinging to its 5-day high of 776.85. But look closer. The Nasdaq 100, QQQ, is weaker at 714.65, down 0.37%, having failed to reclaim its earlier highs. The Dow Jones, Diamonds, is underperforming at 538.19, off nearly a full percent. And the small cap IWM is struggling at 298.25, down 0.51%. The VIX is compressed at 15.81, suggesting the market isn't worried yet, but the sector rotation tells a different story. Energy is the outlier, surging 1.48%, while almost everything else is in the red. Let's bring in grid to map the structure.
The structure is telling a story of exhaustion. SPY is essentially stuck in a box between support at 767.46 and resistance at 776.85. It's not breaking out, it's consolidating. Meanwhile, QQQ is showing clear signs of fatigue. It traded at 714.65 today, well below the 728.54 high from early in the 10-day range. We're seeing a lower high formation on the intraday charts, which usually precedes a test of the 708.5 level, the low established on August 6th.
So SPY is holding, but QQQ is losing ground. What about the small caps?
IWM is in worse shape technically. At 298.25, it's hovering right above the 297.95 support level from yesterday. A daily close below that 297.5 mark would expose a gap fill zone around 292.9. The technical evidence is that the breadth is rotting from the bottom up.
Let's talk about what is actually driving this price action. The headline mover today is clearly the energy sector. The energy sector is up 1.48%, standing alone as the only major sector in green territory. This is happening against a backdrop of Trump's new tariffs boosting solar stocks like FSLR plus 5% pre-market. Why is energy catching this bid while tech sells off? CIPHER, walk us through the flows.
It's a defensive rotation driven by idiosyncratic catalysts rather than broad beta. Look at the pre-market movers. NET jumped 14.6% after Barclays raised its price target to $355. CART gained 14.1% on an upgrade to $63, and MP is up 6.2% on record neodymium-praseodymium sales. These aren't market-wide rallies, they are specific, high-conviction trades. Meanwhile, consumer discretionary and healthcare are taking hits. UAA down 6.4% and RMD down 9.9% on earnings misses. The market is picking winners based on specific earnings quality, not riding the index wave.
And that explains the sentiment disconnect. The VIX is at a complacent 15.81, yet inside the Nasdaq, sentiment is bearish at minus 0.33. We are seeing a picking winners phase where retail and smart money are fleeing megacap tech for these specific energy and industrial plays. It's not that people are scared of the crash yet. It's that they've abandoned the growth narrative for tangible commodity exposure.
I'd push back on the idea that this is just a healthy rotation. The VIX at 15.81 is dangerously low given that the 10-year yield is sitting at 4.69%. You have a flat yield curve plus sticky inflation at 3.46% on the CPI. The market is pricing instability that doesn't exist fundamentally. When the non-farm payrolls come out, if that minus 23K job loss number is confirmed, that low VIX will snap back violently.
Let's drill down into the specific assets driving this divergence. First, let's look at the leader, the energy sector. It's up 1.48% today, defying the broader market stagnation. Grid, what does the technical side of this breakout look like?
Technically, the energy sector is breaking out of a consolidation pattern. While SPY is grinding sideways, the energy sector has found enough volume to push above its recent resistance. However, I'm watching the correlation break. Usually energy moves in lockstep with industrials, but the industrial sector is down 0.85%. So the energy sector is moving on pure supply-side news, tariffs and geopolitics, not broad economic growth. It's an isolated strength signal.
That isolation is key. The fundamental driver here is the supply chain constraint. MP's earnings highlighted record NdPr sales, which is a bottleneck in the renewable and defense supply chains. Investors are buying the energy sector because they believe the tariff environment creates a moat for domestic energy producers. It's a trade on regulatory advantage, not just oil prices.
But consider the risk. If the energy sector is rallying because of tariffs, it implies trade wars are escalating. That hurts multinationals. Look at the technology sector down 0.31% and XHB down 0.89%. The cost of doing business globally is rising. This energy rally might be a liquidity trap if it forces the Fed to keep rates higher for longer.
Now, let's look at the weakness. QQQ is at 714.65, down 0.37%. The data shows NVDA has bullish sentiment at plus 0.32, but the overall Nasdaq index sentiment is bearish at minus 0.33. Pulse, how do we reconcile a single stock being strong while the index sinks? It's fragmentation. NVDA is carrying the weight of belief in AI infrastructure, but the broader sentiment data for the sector is souring. Look at INT. It's strongly bearish at minus 0.67. Meta is also dragging communication services with a minus 0.5 sentiment score. The crowd is rotating out of the story stocks and into cash or defensive plays. The volume in microcaps like XLE hitting 64.7 million shares versus the stagnant volume in SPY tells me retail is chasing low-priced speculation because they don't trust the large-cap tech earnings trajectory.
Technically, that fragmentation is visible in the lower highs. QQQ tried to push to 719.32 on August 6th and failed. Now it's at 714.65. If it loses 708.5, we're looking at a retest of the 700.7 level from August 3rd. The structure is fragile because there is no breadth. It's one or two stocks propping up the index value while the average constituent declines.
The fundamentals bear that out. The 10-year yield at 4.69% is a tax on duration. High-growth tech valuations are compressing because the discount rate is rising. The earnings miss from RMD underscores that consumer spending is softening. Unless NVDA can deliver a surprise beat that offsets the sector-wide margin compression, the technical support at 708.5 is likely to be tested.
Finally, let's look at the casualty list. IWM is at 298.25, down 0.51%, and we saw UAA and RMD gap down nearly 10% and 6% respectively. SPECTER, you flagged the risk in small caps earlier. Where is the danger here?
The danger is the debt wall. Small caps like those in the IWM basket are heavily reliant on floating rate debt. With the 10-year yield at 4.69% and the Fed funds rate held at 3.63%, borrowing costs are at multi-year highs. The minus 23K job loss in the last non-farm payrolls print indicates demand is cracking. Companies like UAA and RMD are reporting misses not because of bad management, but because the customer is gone. If IWM breaks 297.95, we won't just see a technical correction, we'll see a fundamental repricing of credit risk. The VIX at 15.81 is lying to you. It says calm. The balance sheet screams stress.
I agree on the support level. Once that 297.5 level breaks, the stop losses in algorithmic trading systems will trigger, accelerating the move toward 292.9. There is no volume cushion there.
And fundamentally, there is no catalyst to catch the falling knife. Unlike the energy sector, which has tariff tailwinds, small caps are caught in a squeeze between rising input costs and falling demand. Until the CPI comes down from 3.46%, these earnings will continue to disappoint.
We've covered the energy breakout, the tech fragmentation, and the small cap vulnerability. Apex tie this together. How do these pieces fit?
The picture is one of a market forced to choose sides. Grid noted that the energy sector is decoupling from SPY, which means the traditional barbell strategy of holding growth and value is broken. CIPHER highlighted that the earnings quality is deteriorating in consumer and healthcare, pushing capital toward the specific tariff benefits in energy. Meanwhile, SPECTER warned that the VIX at 15.81 is masking the true risk of the 10-year yield, at 4.69% crushing small-cap margins. The result is a mixed regime where broad index exposure is dangerous. The data shows a flight to specific policy-backed assets energy, and a retreat from rate-sensitive growth tech and highly leveraged small caps Russell 2000.
To wrap up the equities edition, the S&P 500 is stalling at 768.56, unable to break the 776.85 resistance without help. The Nasdaq is showing lower highs, with QQQ slipping towards 708.5 as sentiment turns bearish. Energy stands alone, powered by tariff news, while small caps face a technical breakdown below 297.95 amid rising yield pressure. Keep an eye on the VIX. If it rises above 16.5, that complacency vanishes. This is ShadowQuant Equities Edition. Good trading. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.